When I first started trading, I thought finding the perfect entry point was all about intuition. I imagined there was this magical moment where everything aligned, and if I could just spot it, profits would be guaranteed. I spent countless hours staring at charts, studying patterns, and trying to time the market perfectly, and I can tell you it didn't work that way. What I realized over time is that the perfect entry point isn't about luck or psychic ability. It's about following a disciplined, repeatable process that checks every important factor before you commit capital. Today, I want to share with you the 5-step test I go through before ever buying a position, and understanding these steps can completely change how you approach the market. When I first started trading, I thought that spotting the perfect trade meant reacting to every signal I saw on a chart. I would jump into positions based on short-term price movements, news headlines, or what I thought other traders were doing, without really stepping back to assess the bigger picture. I quickly realized that this approach was inconsistent and often costly. One of the first things I learned to focus on is the overall trend before committing to any trade. Understanding the trend is not just about looking at whether the market is going up or down. It's about aligning yourself with the underlying direction so that your trades have a higher probability of success. Entering a trade against the trend might work occasionally, but over time it's much riskier and more likely to erode capital than trades that follow the dominant market movement. Early in my career, I ignored trends and paid the price. I would see a short-term uptick in a stock or commodity and assume it was a breakout, only to have the move fade and reverse against me. Those experiences taught me that short-term signals without context are unreliable. I began to study how trends develop over different time frames and how to distinguish between genuine directional moves and temporary fluctuations. I realized that if I could identify the dominant trend and enter trades that aligned with it, I was stacking the odds in my favor. Trend analysis isn't about being right on every small swing. It's about understanding the market's overall flow and positioning yourself to benefit from it consistently. Assessing a trend requires both observation and patience. Early in my trading, I would get anxious when the market appeared to be consolidating or moving sideways because I felt like I had to act immediately. That impatience often led me to make impulsive trades that didn't align with the trend. Over time, I learned to be patient and wait for confirmation. I would look at multiple indicators, such as moving averages, trend lines, and price structure, to verify that a trend was valid and not just a temporary fluctuation. This discipline allowed me to enter trades with greater confidence, knowing that the move I was participating in was supported by the broader market context rather than just a random blip. Another important aspect of trend analysis is understanding its strength and sustainability. Not all trends are created equal. Some are powerful, sustained moves that can carry a position for days, weeks, or even months, while others are weak, short-lived, and prone to reversals. Early on, I learned to differentiate between these scenarios by looking at volume, momentum, and how price interacts with key support and resistance levels. A trend accompanied by strong volume and clear technical validation is far more reliable than one that appears weak or isolated. By evaluating trend strength, I could avoid trades that were likely to stall or reverse, further increasing my edge in the market. Following the trend also helps reduce emotional stress. Early in my career, I would second-guess every trade because I didn't have a clear framework to rely on. Aligning with the trend provides a guiding principle that reduces hesitation and anxiety. When you know that the market is moving in a defined direction and your trade fits that movement, you can act with confidence and consistency. Trend alignment becomes a lens through which you evaluate every opportunity, ensuring that you are not fighting the market but moving with it. Ultimately, assessing the overall trend before entering a trade is the foundation of disciplined, profitable trading. It's not about perfection or predicting every short-term move. It's about understanding the market's direction, verifying momentum, and positioning yourself to participate in moves that have the highest probability of success. Early in my career, learning to respect the trend transformed the way I approach the market, and it remains a guiding principle that shaped every trade I take. Early in my trading career, I used to think that identifying a trend was enough to guarantee a successful trade. I would see a stock or commodity moving in a certain direction and assume that entering at any moment would lead to profits. What I quickly learned, though, is that not all trends are equal. Not every move is supported by the strength necessary to sustain it. That's where confirming momentum and strength became one of the most critical steps in my process. I realized that even if a trend is in place, a trade without sufficient momentum behind it can stall or reverse, turning a seemingly promising setup into a losing position. Momentum, in trading, is more than just rapid price movement. It's the force behind the market, the indication that buyers or sellers are committed to driving a move forward. Early in my career, I would often misinterpret minor spikes in price as meaningful opportunities only to see them fizzle out moments later. I learned to pay attention to the underlying conviction behind the move. Volume, acceleration, and participation all matter. A trend with strong momentum is like a train with its engines firing full throttle, capable of carrying a trade in your favor, while a trend without momentum is like a train on idle, vulnerable to reversals at the slightest obstacle. One of the ways I evaluate momentum is by observing volume. A move accompanied by increasing volume tells me that market participants are aligned and committed. When I see a trend gaining strength while the volume rises, it signals that the move has the backing needed to continue. Conversely, if a price moves but volume is declining, it's a warning sign that the trend may be weak or losing support. Early in my trading, I overlooked volume and relied solely on price action. I often entered trades that looked good visually but lacked real conviction. Integrating momentum checks into my process helped me filter out weak setup and focus on trades that had the potential to deliver real results. Another aspect of confirming momentum is looking at price structure. I examine how the market behaves around key support and resistance levels. If a stock breaks through resistance with strong conviction and sustained movement, it indicates that buyers are firmly in control. If it struggles to hold above a level or retreats quickly, it's a sign that momentum is fading. Observing these patterns allows me to gauge whether a move is likely to continue or reverse. It's not about chasing every breakout or spike. It's about understanding the underlying strength that supports the move. Momentum confirmation also helps with timing and risk management. When I know that a trend has strong backing, I can enter positions with greater confidence and define risk more accurately. Weak or ambiguous momentum often leads to hesitation or premature exits, which can erode gains and increase stress. By waiting for momentum to confirm the trend, I reduce the likelihood of entering trades that are prone to sudden reversals and increase the chances of capturing sustained, profitable moves. Ultimately, confirming momentum and strength before entering a trade is about ensuring that the opportunity is real and supported by the market. Early in my career, I learned that trends without momentum are traps that can lure traders into losses. By incorporating this step into my process, I improved the quality of my trades, reduced emotional stress, and increased the consistency of my results. Momentum isn't about speed alone. It's about conviction, support, and the market's willingness to carry a move forward. And understanding this is essential for discipline. Profitable trading. Early in my trading career, I often focused so much on potential profits that I completely neglected the importance of evaluating risk versus reward. I would see a trade that looked promising and immediately think about how much money I could make if it went my way, without fully considering what I could lose if it didn't. That mindset led to many losses, and I quickly realized that understanding the balance between risk and reward is one of the most important steps in any trade. Profitable trading isn't just about finding opportunities with upside, it's about finding opportunities where the upside justifies the risk you're taking and where a single misstep won't derail your progress. Evaluating risk versus reward starts with defining exactly how much you are willing to lose on a trade. Early on, I would sometimes take positions that were too large or leave stops unprotected because I wanted to maximize potential gains. That approach is dangerous because a single trade can wipe out weeks or months of gains if the downside isn't controlled. I learned to set precise limits for each position, calculating my maximum acceptable loss before entering. That way, every trade is measured and deliberate, not impulsive or emotionally driven. Knowing my risk in advance gave me confidence and reduced anxiety because I knew that no matter what happened, my exposure was controlled. The next step in evaluating risk versus reward is estimating the potential upside. Don't try to predict the absolute top of a move. That's impossible, but I do calculate a reasonable target based on trends, support, and resistance levels and the underlying strength of the market. I compare the potential gain to the defined risk of the trade. If the potential reward doesn't justify the risk, I don't take the trade. Early in my career, I often ignored this step, thinking that if I was right, the trade would pay off regardless of risk. I quickly learned that consistently taking trades with poor risk-reward profiles leads to losses over time, even if a few trades initially appear profitable. Another key aspect is understanding probability and consistency. Evaluating risk versus reward isn't just about individual trades, it's about patterns over time. I learned to prioritize trades where the expected outcome is favorable, even if not every trade is a winner, by consistently selecting opportunities where the reward significantly outweighs the risk. I was able to let my system work over the long term. Early on, I treated every trade as a binary win or loss, but understanding risk versus reward taught me to view trading as a numbers game where consistency and probability compound into long-term success. Risk versus reward also informs position sizing. A trade with high risk but limited reward might warrant a smaller position, where a trade with a favorable risk-reward ratio can support a larger allocation. I learned to adjust my positions according to both risk tolerance and opportunity quality. That approach ensures that no single mistake can destroy my capital, while allowing me to maximize opportunities that meet my criteria. Early in my career, I often sized positions arbitrarily, which increased both stress and exposure. Evaluating risk versus reward gave me a systematic way to determine appropriate sizing for every trade. Ultimately, evaluating risk versus reward is about creating a rational, disciplined approach to trading. It's about knowing exactly what you're risking, estimating what you can gain, and only committing capital when the trade aligns with your long-term goals. Early in my career, ignoring this step led to impulsive decisions and unnecessary losses. Once I made it a cornerstone of my process, I began taking trades with confidence, managing exposure effectively, and building a sustainable path toward consistent profitability. Timing the entry into a trade is one of the most critical skills I developed as a trader, and it's something I struggled with early in my career. I used to think that the perfect trade meant catching the absolute bottom or top, and I would try to force my entries at what I believed were exact turning points. Inevitably, this approach led to frustration and losses because the market doesn't move in perfect, predictable increments. Over time, I learned that timing isn't about guessing the exact low or high. It's about entering a position in alignment with your trend, momentum, and risk-reward analysis, so that you're maximizing the probability of success while controlling exposure. Learning this distinction was transformative for the way I approached every trade. Early on, I often entered too early because I feared missing out. I would see a trend forming and convince myself that getting in immediately was essential, even if the setup wasn't fully confirmed. Those trades frequently went against me, and I experienced unnecessary drawdowns. I also sometimes entered too late, hesitating because I doubted my analysis or feared acting on an incomplete picture. That kind of hesitation often meant I missed the optimal opportunity and had to chase the move, increasing my risk and reducing potential reward. Both mistakes taught me that successful timing is not about speed or perfection. It's about waiting for the setup that meets all of your predefined criteria. Timing requires patience, and that's something I had to learn the hard way. The market can be frustratingly slow at times, and it's tempting to force trades just to feel active. I learned to wait for precise signals, a pullback to a support level, a breakout above resistance, or confirmation from my system that a trend is gathering strength. These setups aren't guaranteed winners, but they align probability in your favor. Patience allows you to enter trades with confidence because you know the market has validated the conditions you look for rather than forcing an entry based on impulse or emotion. Another critical part of timing is understanding the relationship between risk and entry point. Even if a trade is fundamentally strong, entering at the wrong price can drastically change the risk-reward profile. Early in my career, I ignored this aspect and entered trades without considering how my position size or stop-loss level interacted with the entry price. By learning to wait for the right price, I could define my risk more effectively and maximize the potential reward for the trade. Timing and risk management are inseparable. A well-timed entry reduces exposure, while a poorly timed one can magnify it, even if the trend eventually continues. Timing also reinforces discipline and consistency. When I follow my process and wait for setups that meet all my criteria, I stop reacting impulsively to every market move. I no longer chase trades out of fear or excitement, and I don't second-guess myself once the entry conditions are satisfied. This consistency in timing is what separates professional traders from those who rely on luck or emotion. It allows you to apply your system repeatedly, evaluate performance objectively, and trust that your approach will produce results over time. Ultimately, perfect timing doesn't mean perfection. It means alignment with probability, process, and risk control. Early in my career, I thought timing was about instinct or catching the exact bottom. But I learned that consistent, disciplined entries are far more valuable than any single perfect trade. By waiting for setups that meet my criteria and respecting the dynamics of the market, I could enter trades with confidence, control risk effectively, and increase the likelihood of long-term success. One of the most overlooked yet crucial steps in trading is ensuring emotional and mental readiness before entering a trade. Early in my career, I would often find myself rushing into positions because I felt I had to act, or because I was reacting to market movements, headlines, or what other traders were doing. I didn't realize at the time how much my mindset was influencing my decisions. Fear, excitement, and impatience were constantly steering my actions, and that led to inconsistent results and unnecessary losses. Over time, I learned that no matter how strong the trend, how favorable the momentum, or how perfect the risk-reward ratio, entering a trade without mental readiness dramatically reduces the odds of success. Emotional and mental readiness starts with self-awareness. I had to learn to recognize my own state before placing a trade. Am I calm and focused, or am I acting out of stress, anxiety, or the fear of missing out? Early in my career, I would ignore these feelings, thinking that trading required me to act regardless of how I felt. That approach often led me to make impulsive decisions, enter trades prematurely, or deviate from my rules. Once I began pausing to assess my mindset, I noticed a profound difference. When I am in a clear, focused state, I can apply my process, objectively execute trades according to my criteria, and maintain discipline even when the market is volatile. Another aspect of readiness is preparation. I have learned that confidence in a trade comes not from hope or luck, but from following a structured process and ensuring all prior steps are checked. Before entering a position, I review the trend, confirm momentum, evaluate risk versus reward, and time my entry carefully. Completing these steps methodically primes my mind for execution. When every factor aligns and I am mentally prepared, I trade with clarity, not impulse. Early in my career, skipping this review or entering trades in haste often resulted in mistakes that could have been avoided with proper preparation. Mental readiness also involves managing stress and expectations. Markets are inherently unpredictable, and even the most favorable setup can produce an unexpected outcome. I've learned to enter trades with realistic expectations and a mindset that accepts that losses are part of the game. Early on, I would take losses personally, let them affect my confidence, and make irrational decisions in response. Developing mental readiness allows me to detach my ego from each trade, focus on executing my process, and treat each position as a learning opportunity, regardless of the outcome. This mindset reduces emotional swings and keeps me consistent over time. Additionally, readiness is about recognizing the right timing to act. Even if all technical and fundamental criteria are met, if I'm mentally distracted, fatigued, or emotionally charged, I know that executing a trade at that moment is likely to be suboptimal. Early in my career, I underestimated the importance of being fully present and focused. I learned to step back, wait for the moment when I am fully prepared, and only then commit capital. This discipline ensures that I am acting deliberately, not reacting emotionally, which is a key difference between amateur and professional traders. Ultimately, emotional and mental readiness is the final safeguard before entering any trade. It ensures that you are acting rationally, following your process, and applying your rules consistently. Early in my career, ignoring this step led to impulsive trades, poor decisions, and unnecessary losses. By taking a moment to assess mindset, focus, and preparedness, I am able to enter positions with confidence, reduce the influence of emotion, and maintain consistency in performance, which is essential for long-term profitability. One of the most important lessons I learned in my trading career is that following a structured, repeatable process is far more valuable than relying on intuition or luck. Early on, I thought that being a successful trader meant being fast, having a keen eye for patterns, and reacting instantly to market movements. I would jump into trades based on what I felt the market was going to do, or because I feared missing an opportunity. That approach produced inconsistent results, and I quickly realized that talent or instinct alone wasn't enough to build sustainable profitability. What changed everything for me was developing a clearly defined process that I could follow consistently, step after step, for every trade. A structured process begins with rules. Early in my career, I didn't write down rules. I just had them in my head, and I often bent or ignored them under pressure. I would enter trades because a trend looked promising or exit early because I was anxious, and that inconsistency caused more losses than I care to admit. Once I committed to a documented, repeatable process, I could evaluate trades objectively and execute decisions without being influenced by emotion. Rules remove guesswork and create a framework for every trade. They define entries, exits, position sizing, and risk management, which collectively provide clarity and confidence in each decision. Another key advantage of following a process is consistency. Markets are unpredictable, and trying to predict every move is a losing strategy. A disciplined process ensures that I act according to probabilities and predefined criteria rather than reacting impulsively. Early on, I would let short-term market noise dictate my actions, jumping in and out of trades, second-guessing every decision. Following a repeatable process allowed me to filter out that noise, focus on high-probability opportunities, and execute trades consistently. Consistency, I learned, compound over time far more than occasional lucky trades. Following a process also creates a system for learning and improvement. Early in my trading, it was difficult to analyze performance because I was inconsistent and made decisions based on emotion rather than logic. By applying a structured approach to every trade, I could track outcomes, compare results to my criteria, and identify patterns in both success and mistakes. The process turns each trade into data, providing a feedback loop that is essential for refining strategy. Without this, learning is random and slow. With it, learning accelerates because you know exactly which decisions were sound and which were flawed. Risk management is another reason process is essential. Early in my career, I sometimes took positions without fully considering exposure or stop-loss placement because I was caught up in excitement or greed. Following a structured process ensures that risk is evaluated for every trade and that limits are applied consistently. It's not just about protecting capital. It's about creating the conditions for compounding success. By knowing that risk is controlled, I can act confidently and avoid letting emotions influence decisions mid-trade. Finally, following a process builds confidence. When I know I've followed all the steps in my system, check trend, confirm momentum, evaluate risk-reward, time my entry, and ensured readiness, I can execute trades without hesitation. Early in my career, I constantly second-guessed myself, and that doubt often led to premature exits or overcompensated adjustments. Following a repeatable process removes doubt and creates trust in your approach, which is critical for consistency and long-term success. Ultimately, committing to a structured, repeatable process transforms the way you approach trading. It replaces guesswork and emotional decision-making with discipline, consistency, and clarity. Early in my career, ignoring this principle led to random outcomes and unnecessary losses. Once I embraced it, every trade became a calculated decision guided by rule, and that shift marked the difference between gambling and profession. Sustainable trading patience is one of the hardest lessons to learn in trading, and early in my career, I often underestimated its importance. I used to believe that a successful trader had to be constantly active, jumping on every opportunity as it appeared. I thought that missing a move was a personal failure, and that acting quickly was the key to profits. That mindset led to overtrading, poor entries, and unnecessary stress. Over time, I realized that patience is not a passive state. It's an active discipline that allows you to wait for the highest probability setups, manage risk effectively, and let your strategy work over the long term. Learning to cultivate patience fundamentally changed the way I approach the market. Early in my career, impatience caused me to take trades that didn't fully meet my criteria. I would see a trend forming and feel pressure to enter immediately, even if the momentum wasn't fully confirmed or the risk-reward ratio wasn't ideal. Those trades often went against me, reinforcing the lesson that acting too quickly can be more costly than waiting. I had to learn that waiting for the right setup is not lost time, it's preparation. Each moment I spent observing the market, confirming momentum, and ensuring alignment with my strategy increased the likelihood that my eventual entry would be successful. Patience, in this sense, is a form of strategic advantage. Another aspect of patience is resisting the temptation to chase trades. In the early days, I would sometimes enter positions late, chasing a move that had already advanced significantly. That behavior increased risk, reduced potential reward, and often led to stress-induced decisions. I learned that missing a single move is not the end of the world. The market is always presenting opportunities, and forcing a trade out of impatience almost always leads to mistakes. Patience allows you to wait for situations where the odds are clearly in your favor rather than trying to participate in every minor swing. Over time, this discipline compounded into better results and more consistent performance. Patience also interacts directly with risk management. A patient trader doesn't need to over-leverage positions or take excessive risk to make gains. By waiting for setups that align with your rules and have favorable risk-reward ratios, you naturally reduce exposure and protect capital. Early in my career, I often took on excessive risk to compensate for impatience or missed opportunities, which magnified the consequences of mistakes. Learning to be patient allowed me to enter trades with proper position, sizing, and defined stops, which increased both safety and confidence. Mental readiness is another key component tied to patience. The ability to wait requires a clear, focused mindset. I've learned that impatience often arises from emotional states, fear, greed, or frustration, and acting on these emotions almost always leads to errors. By cultivating patience, I train my mind to remain calm and disciplined, observing the market objectively and acting only when conditions fully meet my criteria. This mental discipline is a hallmark of professional trading, separating consistent performers from those who rely on luck or reactionary impulses. Ultimately, patience is about respecting the process and trusting that following your rules will produce results over time. Early in my career, I thought that frequent action equaled progress, but I discovered that deliberate, well-timed decisions far outweigh constant movement. Patience allows you to enter trades with higher probability, manage risk effectively, maintain emotional control, and let your strategy work for you rather than against you. Developing this discipline transformed the way I interact with the market and marked a critical step towards sustainable, long-term profitability. One of the most important lessons I learned in my trading career is that risk management is not optional, it's central to survival and long-term profitability. Early in my career, I often ignored or underestimated the importance of controlling risk, thinking that my skill at identifying trends or timing entries would be enough to protect me. I would occasionally take positions that were too large or fail to set stops because I was excited by a trade or overly confident in my judgment. Those decisions often led to losses that could have been avoided, and over time I realized that protecting capital is as important, if not more important, than chasing profits. Effective risk management starts with position sizing. I quickly learned that no matter how confident I felt about a trade, putting too much of my capital into a single position magnified potential losses and created unnecessary stress. By calculating position sizes based on the risk I was willing to tolerate, I could limit the impact of any single trade on my overall portfolio. Early in my career, I often neglected this and treated every trade the same, which meant that even small mistakes could have outsized consequences. Learning to size positions appropriately not only protected my capital, but also gave me the mental freedom to stick to my process without fear. Stop-loss placement is another critical component of risk management. I used to view stops as optional, thinking that I could manage trade manually or that the market wouldn't move against me too quickly. That mindset was dangerous. Over time, I realized that well-placed stops are a safeguard, not a limitation. They define the maximum potential loss and allow me to participate in trades without exposing myself to catastrophic risk. Early in my career, failing to set proper stops led to losses that were both financial and emotional. Once I committed to disciplined stop placement, I could trade with confidence, knowing that my exposure was controlled and that a single adverse move wouldn't derail my entire strategy. Another aspect of risk management is evaluating risk-reward before entering a trade. Early on, I would sometimes jump into trades with minimal upside but significant potential downside, driven by excitement or impatience. I learned that every trade should offer a favorable risk-reward profile, where the potential gain justifies the risk being taken. This assessment forces discipline and ensures that over time, the cumulative effect of profitable trades outweighs the losses from unfavorable outcomes. It's not about avoiding losses entirely. It's about making sure the ones that occur don't threaten long-term progress. Diversification and hedging are also essential elements of managing risk. Early in my career, I sometimes concentrated my positions in a single sector or asset because it seemed promising. That strategy can work for a time, but it increases vulnerability to unexpected market shifts. I learned to spread risk across multiple opportunities and to use hedges where appropriate to protect against adverse movements. This doesn't mean reducing potential gains unnecessarily. It means create resilience so that no single event can undo months of work. Risk management is ultimately about creating a stable platform from which disciplined trading can operate. Emotional control is intertwined with risk management. I've observed that even the best strategy can fail if emotions take over. Fear and greed can cause traders to abandon stops, overtrade, or take on positions that are too large. By integrating strict risk management rules into my process, I remove much of the emotional burden from trading decisions. When I know that losses are limited, positions are sized properly, and risk-reward is favorable, I can execute trades calmly and consistently. Ultimately, disciplined risk management is the backbone of sustainable trading. Early in my career, ignoring it led to unnecessary losses and stress. Over time, I learned that protecting capital, sizing positions correctly, placing stops, evaluating risk-reward, diversifying, and maintaining emotional control are all part of a systematic approach that allows consistent long-term success. Risk management doesn't guarantee that every trade will be profitable, but it ensures that losses are manageable and that your process can continue to work over time. One of the most important realizations I had as I developed as a trader is that discipline and consistency are far more powerful than short-term skill or luck. Early in my career, I would sometimes make great trades, sometimes poor trades, and my results were erratic. I thought that being smart or having insight into the market would be enough to achieve success. I quickly discovered that without discipline and consistency, even the best strategies fail. Markets are unpredictable, and relying on intuition or occasional brilliance doesn't produce reliable results. What makes a trader truly profitable over time is the ability to follow a system and execute decisions consistently, regardless of emotion or short-term outcomes. Discipline starts with following your process. Early on, I had rules in my head, but I often bent or ignored them when the market got stressful or exciting. I would enter trades impulsively, exit positions prematurely, or alter my plan based on fear or greed. That lack of discipline undermined my results. I learned that having a clearly defined process and sticking to it, no matter what, is what separates professional traders from amateurs. Discipline means executing each trade according to your criteria, managing risk according to your rules, and not allowing emotions to override logic. The market tests patience and self-control constantly, and discipline is the tool that allows you to pass those tests. Consistency is closely linked to discipline. Even a solid strategy will fail if applied inconsistently. Early in my career, I had periods of success followed by streaks of losses, largely because I was inconsistent in execution. I might follow my rules perfectly for a few trades, then allow emotions to dictate decisions for the next set. Over time, I realized that profitable trading is a long-term game. Consistency in applying your process allows you to capture the cumulative advantage of favorable trades and minimize losses over time. It's not about being perfect in every trade. It's about being consistent in how you approach each opportunity. Part of achieving discipline and consistency is managing your emotional state. Early on, I would let fear, greed, or frustration influence my decisions. A single loss might trigger overcompensation in the next trade, or a small win might tempt me into taking unnecessary risks. I learned that disciplined traders recognize these emotional triggers and act in spite of them. You can't control the market, but you can control your behavior. By maintaining consistency in execution and decision-making, you ensure that your action reflects strategy, not impulse, and that over time, your process produces results. Another key aspect of discipline and consistency is patience. Following a systematic approach requires waiting for the right setups and resisting the temptation to act on incomplete signals. Early in my career, impatience led me to enter trades too early or chase moves that had already run. That behavior often increased risk and reduced reward. Discipline teaches you to wait for the setups that meet your criteria, and consistency ensures that you apply the same standards to every opportunity, avoiding the pitfalls of selective judgment or emotional bias. Monitoring performance and learning from experience also reinforce discipline and consistency. Early in my career, I tracked results haphazardly or not at all, which made it difficult to understand what worked and what didn't. By consistently recording trades, analyzing outcomes, and refining my approach, I created a feedback loop that reinforced disciplined behavior. You start to see patterns in both success and mistakes, and you can adjust your process without letting emotions dictate decisions. Discipline becomes ingrained through repeated, consistent practice. Ultimately, discipline and consistency are the backbone of sustainable trading. Early in my career, ignoring these principles led to erratic results and unnecessary losses. Once I embraced them, every trade became a calculated action rather than a gamble. I could execute my process repeatedly, manage risk effectively, and approach the market with confidence. Discipline and consistency are what allow a trader to survive the inevitable challenges and capitalize on opportunities over the long term. One of the most valuable lessons I learned as a trader is that consistently applying a proven process transforms trading from guessing into a calculated endeavor. Early in my career, I treated trades like experiments or hunches, hoping that my instincts would carry me to success. Sometimes they did, but over the long run, that approach was unreliable and costly. I realized that what separates profitable traders from the rest is not occasional brilliance. It's the disciplined, consistent application of a process that has been tested and refined over time. Every trade becomes a deliberate decision executed according to rules rather than impulse. And that approach fundamentally changes the outcome of your trading journey. Applying a process consistently begins with preparation. I make sure that before any trade, I have reviewed the trend, confirmed momentum, assessed risk versus reward, and ensured that my entry timing aligns with my strategy. Each step serves as a filter to identify high-probability opportunities and avoid unnecessary risk. Early in my career, I would sometimes skip steps or rely on intuition to move faster. That often led to mistakes and inconsistent performance. By committing to the full process every time, I developed a system that allowed me to make decisions objectively and confidently, regardless of the market's noise or volatility. Consistency also requires patience and discipline. Even when the market offers tempting opportunities, I resist entering trades that don't meet my criteria. Early in my career, I would chase trades out of excitement or fear of missing out, only to see them fail. Learning to follow the process without deviation ensures that every trade has a favorable probability of success. It also helps me avoid emotional decisions, which can erode both capital and confidence. When you consistently follow a proven approach, your results over time are driven by probability and logic, not luck or guesswork. Another key aspect of applying a process consistently is risk control. Every trade is evaluated for position size, stop-loss placement, and potential reward relative to risk. Early in my career, I underestimated the importance of this step and sometimes exposed myself to losses that were disproportionate to potential gains. Consistency in applying risk management rules ensures that no single mistake can derail your overall strategy. It also allows me to participate in trades with confidence, knowing that the downside is contained and the process is working as designed. Following a systematic approach also creates a feedback loop for learning and improvement. Each trade becomes data, providing insight into what works and what doesn't. Early on, I struggled to evaluate my performance because my decisions were inconsistent and unstructured. By consistently applying a process, I could analyze results, refine my criteria, and optimize my strategy over time. This iterative improvement is only possible when a process is applied faithfully. Without consistency, it's difficult to separate noise from meaningful patterns. Consistency in execution also builds confidence and mental resilience. Markets are inherently unpredictable, and even high-probability trades sometimes fail. Early in my career, I let a few losses shake my confidence and influence subsequent decisions. Applying a disciplined process consistently taught me to trust the system and remain focused, even when individual trades don't go as planned. That trust is crucial for long-term success because it prevents emotional reactions from undermining your approach. Ultimately, consistently applying a tested process transforms trading into a disciplined, repeatable activity rather than a series of guesses or impulses. Early in my career, I relied too much on luck, intuition, or sporadic insight, and my results reflected that. Once I embraced consistency, every trade became a calculated decision executed according to rules, with controlled risk, disciplined entry, and alignment with my overall strategy. Consistency allows probabilities to work in your favor, ensures disciplined behavior, and builds the foundation for sustainable profitability over the long term.